people like me will be saying, maybe they are looking to throw our economy into recession in order to get this under control. And there's a certain pattern that we've seen in the past when this situation develops. It's the crunch in the economy with the higher interest rates, and then the economy responds. It gets crunched and the inflation disappears very quickly and the interest rates come down quickly. So this is something people need to get their head around for the moment.
Welcome back to Tea with Tony. Globally and locally, citizens are doing the hard yards. We're feeling the ongoing pain of everyday increases in living costs and getting stung by rising interest rates to boot. Ironically, it is the rising interest rates that will bring inflation back under control. But it's fair to say that this short-term pain for long-term gain is biting. The good news is there is some improving optimism in New Zealand business confidence, albeit with significant challenges. Let's get Tony's perspective. Hi, Tony. How are you?
Good, thanks, Lenska. Good to be back again.
I say you're in Australia. You've abandoned us.
Yes. I'm doing it in about 4 to 5 week blocks now of looking to spend at least 25% of the year. It might creep to a third, actually, over here in Oz. I mean, the weather is usually better. There's still some decent downpours here on the Gold Coast. But I tell you what, I mean, over here today, I think it's going to hit about 26 degrees. No warnings of watch out for hypothermia on the Gold Coast, as I've been seeing from the New Zealand media just recently.
Well, there was this much snow on the ground here yesterday morning, so that's quite interesting. Anyway, we better crack on. I'll give you some more stuff about your suntan later. So look, I want to start on the business confidence side and what that kind of means for everyday Kiwis. So according to recent surveys, business confidence is less pessimistic. Talk us through that, Tony.
Yes, no one could claim that businesses are feeling optimistic about the future. We've had one of the surveys showing a net 42% of businesses have a negative outlook for the economy over the coming year. The interesting bit is that's an improvement from the previous month when it was a net 62% negative outlook. So it's better, but at minus 42%, you'd look at that and on a standalone basis, you'd say, well, I guess that means the economy is probably going to go into recession. But that's why us economists like these particular surveys, because the people running them, the ANZ, the NZIER, for instance, they never just ask the one question, are you feeling happy or sad about the future? It gets to, what are you going to do about it? They ask them, are you going to hire people? Are you going to invest? Now, when it comes to investing, capital expenditure, things are sort of slightly negative, but not absolutely horrible. On the employment side, one of the measures I saw the other day was about plus 13%. Businesses are actually still saying they're going to hire people. And that's why people have to be very cautious when they look at some of these sentiment surveys. If you've been doing this for a number of decades, you'll go, that's so negative. Everything's looking bad. I'm going to sell all my assets, etc. But firms still want to hire people. And as I've been highlighting in my many presentations around the country when I'm there, that's one of the unique features this time around, shortages of labor. And to most people, recession doesn't mean, oh my goodness, GDP just fell by 1%. It's sort of meaningless. It comes down to, I've lost my job, or my mate has lost his job, or I might lose my job. That is absent this time around.
To play that back, what you're saying is that the labour market is so tight that there is confidence for everyday Kiwis. So that's actually good. It's a good thing, isn't it?
It's a good thing, but that's where the timing is very, I guess, unfortunate, because if we're seeing the likes of 3.3% unemployment rate, I think it was about 42% of businesses saying the main reason they can't increase output is lack of labour, and one of the recent surveys, etc. Every part of me would be screaming, demand higher wages, higher salaries. The great opportunity to do that, first decent opportunity in who knows 3 or 4 decades in New Zealand. But the timing is unfortunate. We've had these inflationary surges related to the pandemic, supply chain disruption, energy, war crisis across in Europe, etc. And so that is the key thing which is occupying the minds of central bankers. Central bankers know when you raise interest rates, as we've seen in New Zealand, the official cash rate over the past year from 0.25% to now 3.5%, they know it's going to restrain activity. But if they look at what happened in the past when you'd have a movement like that, they'd say, okay, it means inflation gets suppressed by sort of this much. Not now, because of the low unemployment rate, the potentially strong wages growth. So a lot of our focus now is on, okay, we can see interest rates going up. Is it causing a dent yet in the labour market? That's where we're having to pay a lot of attention. And at the same time saying, well, I guess I'd go on strike if I didn't get a 10% increase given what's just happened. So this is quite a unique environment. And that means that while people like myself have been saying for a wee while, I think if I was borrowing, I'd look at fixing 1 to 2 years. It doesn't mean I've got the likes of 95% confidence in late 1993. The interest rates are falling away greatly because inflation's under control. We haven't had these unique circumstances ever before in a deregulated economy tightening cycle in New Zealand. So people just need to keep that a little bit in mind. And it does say there is still upside left for the interest rates here in New Zealand. The Reserve Bank is basically certain to go again. But people should just note what happened in Australia, where the Reserve Bank was expected to increase 0.5%. They only went by 0.25%. They said they're just a wee bit worried. They might be going a little bit too fast. They just want to buy themselves some time to see how things are going to pan out, but they still expect to take rates higher. And I think that's a stage we're going to get to in New Zealand, maybe from November as well. Bit of a pause in there.
So look, we're going to talk about interest rates and inflation, but before we do, I just want to sort of touch on, are we heading into a global recession?
Well, global recession is certainly reasonably probable. We've got the IMF downgrading their forecasts for growth for about the fourth review in a row, saying they do expect 1/3 of the world economy is going to have a recession at some stage next year. And one can fully understand why they'd say that, given the pressure we've seen on the cost of living increases, the energy prices out there, and just the inflation fight. And they're looking at the fact that inflation rates are still relatively high. These labour markets are unusually strong. And so saying, well, maybe that there is going to have to be a case of some economies having to be thrown into recession in order to get their inflation under control. And of course, that is the big debate in the United States. In Europe, it's more centred around the impact of the war, the energy crisis, deficiency of gas supplies, gas prices, etc. In the United States, it is very much about inflation too high, sort of a traditional inflation fight, and maybe they have to go into recession in order to get inflation consolidating back in 2%. But there's still a lot of water to go under the bridge, and people should anticipate that the sort of volatility we've seen in recent weeks and the interest rates, the wholesale rates have been up and down like we haven't seen for a long time.
The trajectory of the OCR looks like it's been jacked, hasn't it, compared to what we were talking about. That you were saying, I think, that we would peak around 4% at one point, but now we're going higher, aren't we?
Well, yeah, I mean, initially I was thinking maybe they only need to take it to 3% was my original view, on the basis of I could see evidence of consumer spending being pulled back. And consumer spending definitely has fallen away, and I think there is a lot more weakness to come. So for anybody in the retailing sector out there, you've got all these things negatively affecting your demand. 2 years of binging that we've done for the pandemic, we're pulling back on buying spas that we already have, etc. The interest rates increasing at a record pace. We feel poorer because the house prices have fallen on average by 12%. Credit is harder to come by compared with what it was before. We've got net negative migration outflows of about 12,000 in the past year. Oh, and now we can travel overseas, so we're allocating money to doing that rather than buying things domestically. So certainly on the retailing side there, the outlook is still relatively negative and challenging. And for the interest rates, the implications are that, okay, that looks like it's going to cause interest rates not to go up all that much because the Reserve Bank is targeting household spending. But we still have this underlying strong labour market and the risk that even though consumer spending is getting crunched, you still get an acceleration in wages growth. And of course, we see industrial activity picking up predominantly in the public sector. So we do have to put that a little bit to the side. But it does it will lead to influencing private sector claims. And I know from speaking with people in recruitment agencies that they are seeing very strong increases in salaries, the sort of businesses that they deal in there, definitely 10, 20, sometimes 30% increases in salaries out there. And so that does mean we've seen this lifting of expectations for where interest rates would go to 4.25% is where the Reserve Bank sits for the peak, for the official cash rate. We've got some other large groups of forecasters out there thinking it could be 4.75%. You couldn't rule that out. I don't think so. I'm not there yet in terms of picking a peak of 4.75%. But you couldn't rule it out because we simply don't know how wages growth is going to respond in this environment.
Where would you see with an OCR, say, let's go to 4.25? An OCR of 4.25 doesn't mean a lot to a lot of normal people. What would that what could that translate to in terms of retail rates that we pay? And I know it's largely depends on the floating rate for OCR, but let's have a stab at it so people get a sense of, if we go to 4.2, could that mean?
Okay, it means that if the banks have already adjusted their floating rates for the 0.5% increase that we've just seen, that there's another 0.75% they'll put on the floating mortgage rate. So people should think in terms of when the cash rate goes up 0.25%, floating mortgage rates go up roughly 0.25% very quickly afterwards. So definitely you'll see the floating interest rates going up more. For the 1-year fixed mortgage rates, we've got those sort of around about 5.5% now. There's further upside that will happen for those ones, but it's not guaranteed that even if we go to 4.75%, that the 2-year plus fixed mortgage rates will go up, because if we go into 4.75%, people like me will be saying, maybe they are looking to throw our economy into recession in order to get this under control. And there's a certain pattern that we've seen in the past when this situation develops. It's the crunch in the economy with the higher interest rates, and then the economy responds. It gets crunched and the inflation disappears very quickly and the interest rates come down quickly. So this is something people need to get their head around for the moment. The more rapidly that interest rates go up now and the higher they go, frankly, the more quickly they'll start coming down again. And that's why, even though as my expectations for the interest rates go up and up a bit in the short term, I'm still thinking that there could be some decent declines towards the end of 2023. So basically a year from now. I'm still sticking with that view, essentially, is what I'm saying there.
And look, I spoke to a couple of our business owners this morning and our lending expert, and it is our clients are actually faring reasonably well as the general feedback, but people are it's tough out there. So I'm not saying everyone's got it rosy, because that's not the case, but the nature of our business and our proposition is such that we try and make sure people have a plan and kind of, as I always say, take control. But it was positive to see that we track people who are in arrears, and our numbers are actually declining on that fact. So that's actually a real positive for NZHL. But increasingly people coming in the next few months, there are still people coming off these very low rates, Tony, and moving to higher rates. Sometimes they're doubling, and that is, that affects people. So having a plan and taking control of that situation, ironically, when you do, you can actually even do better out of it, is what we're finding. But it is a very difficult pill to swallow initially. With petrol and supermarket prices on the top of that,
Yeah, exactly. I mean, as people like myself have been pointing out for some time now, with interest rates rising, very few people will actually end up paying an interest rate, a new high interest rate here, which is above the interest rate their bank made them prove they could service when they took the mortgage out 1, 5, 10 years ago or whatever. I mean, the test interest rate at the moment, if you go to the bank at the moment and say, I want to borrow and I'm looking at fixing 1 year at 5.5%, the bank isn't going to work out your ability to pay 5.5. It's going to be as high as 8.15% for one of the institutions out there, for instance. And so back a year or so ago, year and a half ago, you had to prove you could service about 6.5%. But it does mean with your interest rate doubling for so many of these newer borrowers, it'll crunch their spending in other areas, and they will be able to do it. But again, that's why I did that little list earlier on for the retail sector in New Zealand. There are just so many negative factors, actually suggesting if one is looking to buy a few things as a consumer, you could actually see some decent sales in the next few months, because what's already happening in the United States is the inventories are becoming excessive. They ordered so much stock last year. The example is always given, I think it was of Walmart chartering their own boats to get stuff out of China. Well, the stuff showed up now. It's filling up their warehouses. They're looking to get rid of it. So that will be a deflationary pressure out there. I expect the same thing in New Zealand. So some decent discounting of some of the lumpy consumer goods over the next 6 to 9 months in New Zealand.
Okay, interesting. Look, finally on that kind of zone before we get on to housing, the Kiwi dollar, it's a bit of talk, so she's tanking, baby. How does that link in brief to how and why does it matter? And by the way, I just cancelled all thoughts of a holiday. I'm just not going on holiday while the Kiwi dollar is sitting like that. But why is that important?
Okay, first of all, the Kiwi dollar and its movement is one way in which a change in interest rates. Let's talk about the United States, because over the past year we've gone from 69 US cents to 57 or so now. That's one way in which, if they put interest rates up over there, it leads to interest rates also going up over here. And you go, but what if our economy was completely different? The transmission mechanism, as we economists call it, is US interest rates up. Ooh, money goes into the US dollar. Kiwi dollar goes down, our import prices get more expensive, more inflation here, and so the Reserve Bank reacts to that by putting interest rates higher. So that's the way the currency's decline of 12 cents in the past year actually is causing higher than would otherwise be the case interest rates in New Zealand. That's sort of the negative aspect of it, but if you're a saver. The positive, of course, is that the currency is 12 cents lower over the past year. People are talking about over a $10 payout from Fonterra, for instance. It's a good thing for our export sector. And this is something I focus on quite strongly, where even though we have the IMF saying maybe 1/3 of the world will hit recession at some stage in 2023, for New Zealand, our export prices are still good. The currency hasn't been overvalued for a long time. We're quite undervalued at the moment. There's really good support for our export sector. Obviously, the primary sector there, and the increasing number of tourists coming through, the increasing number of students, especially for the first semester next year. So the fall in the exchange rate, it is a big move. It'll mean interest rates higher than would otherwise be the case, but it's quite good for our sort of underlying economic base of producing food, etc., that the rest of the world wants, especially with climate change impacts on food production and food prices overseas.
Finally, the housing market. We're in decline, as we know. I've read and seen things that the decline is easing. Talk us through it.
Yeah, okay. So the thing I started saying, I think over 2 months now, was we have entered the end game, meaning house prices are still going to fall further. House sales are still going to weaken further. Stocks are still going to go up a little bit. It'll take longer on average to sell a property. But the speed with which the housing market is falling away, starting to flatten out. And so some flattening is occurring there. And one of the driving forces is a lot of first home buyers now coming back into the market. I first of all saw this in my monthly survey of mortgage advisors. That seems to be proving to be the greatest on the spot leading indicator of what's happening out there. The most recent survey 3 weeks ago, a net 47% of the agents were saying they're seeing more first home buyers looking for advice. A month earlier, it was a net 20 something. In my most recent survey of real estate agents, now about a week old, a net 27% there said they are seeing more first home buyers in the market. Now, none of my 5 surveys show that there are more investors appearing to any sort of overall positive degree yet. But in most of the surveys, it's showing the extent to which the investors are stepping back from the market is easing. So they're just starting to sniff around. They're becoming a little bit more interested. One of my measures shows that they are thinking in terms of maybe finding a bargain or two are out there. But with the interest expense deductibility tax rule change, a key influence will be what the opinion polls and political opinion polls are showing. And if it looks like we're going to get a change in government towards the end of next year, then anticipation of interest expense deductibility coming back again, that'll see the investors coming back into the market in 2023. I think it's a little bit too early for those that are reliant on that sort of the cash flow financing. For the longer term investors who are pretty well cashed up, they've probably already been buying, taking advantage of the doubling of listings from a year ago anyway, quite frankly. So, yeah, I think we're not turning, we're not going back up, but I do still have the view that that might happen around the turn of the year, meaning December, January, February, something like that. And I do expect on average house prices will rise in 2023, but not by much at all, not by much at all, given that the interest rates, etc., net migration outflows. Yeah.
Look, we're seeing first-time buyers back in the market as well, and we're a kāinga ora provider, so which there's only a limited number of us. So definitely seeing more in that space, and a lot of people, first-time buyers, will come and see us to kind of get a plan together. Because it's a process, right? But it's nice to see them back in the market, and it's nice to see some sanity, but also there is a bit of pain. And look, there is that challenge we've talked about before, where first-time buyers that bought in the last 2 years are starting to see some capital erosion, and for some there is this risk of negative equity, and we always talk about the long term and riding it through if you can, and you would lend the money generally because you can afford it because of those test rates, but there's those little sticky fringes that are a bit tough for people at the moment. Okay, Tony, well, is there anything else that we haven't covered that you'd like to add? Because it is, as we keep saying, a little bumpy and irregular out there at the moment.
I made a little list just as we were doing the initial chatting early on, and we've pretty much covered all the things I've got in here regarding what we economists are looking at quite closely. It's not just actual inflation, it's the labour market. And so we're looking for signs of weakening in the labour market. And I know a lot of people will be out there and going, but we want to have the economy growing. We want a strong labour market. Why would the Reserve Bank want to stop that? Well, its job isn't to suppress the economy. Its job is to try and keep inflation close to 2% over the medium term. And when you've got inflation at 7.3%, most people are going to realise something probably has to change. And when we've had these record low interest rates from 2019 through to early this year, there's a bit of sort of debt-driven momentum in the economy to unwind. So, people should be in no doubt that if we're still sitting here in 6 months' time and I'm saying there's actually still not that much evidence of inflation coming down, then I might be saying, they may have to put us into recession like they did in 2008 in order to control inflation. I don't think that they will, but that is certainly what the debate is all about in the United States at the moment. So the situation is still exceedingly fluid out there. People should continue to expect currency going up and down, wholesale interest rates going up and down as well. And we economists, every day, we're learning something new about our economies. And especially just a final comment, maybe just keep in mind the fact that around the world, we haven't actually seen proper sustained monetary policy tightening cycles like this since before the global financial crisis.
No.
Well, the world, all the relationships are different from back in 2007 to where we are now, sort of 15 years later. So hence the uncertainty, and maybe just keep that in mind when you are looking at your borrowing. Don't completely poo-poo the idea about maybe having a portion of one's debt fixed for 3 years because there is still a high level of uncertainty out there. And I'd like to say, but we're going to be quite certain about everything in 12 months' time. No, there'll be new shocks coming along, which we're all going to have to adjust to. So focus on your ability to adapt to the uncertain circumstances which continue to hit us, it seems, every month or so.
Yeah, and get good advice, like we always say, make a plan, and a fluid one at that at the moment. Right, well, thanks, Tony. As always, nice to see you. And as we always say, Tony is an independent economist. We like it that way. His views are not necessarily those of NZHL and vice versa. So thanks, Tony. We'll see you again next month. I can't believe we're heading into Christmas.
Yeah, not too long now. Look, thanks, Lenska, and thanks and good luck out there, everybody.
I
Cheers.
do have one final call out. Someone made a comment on this session that it was clickbait because we're not drinking tea anymore, and I thought that was really funny. So the context to that is, of course, that when we used to do this in person pre-COVID, we always had a little teapot with our tea, which you normally hated, if we're really honest.
Yeah.
So I forgot to bring my cup of tea, so I'm not accused of clickbait around the tea. I'm not sure how tea is a clickbait, but I'm up for it. So we need to
Well,
reinstate that. Oh, you bought yours. Oh, there you go.
yeah, but it's coffee. It's
Oh,
coffee. It's my own cappuccino. I'm not a big tea drinker. So even when you would give me that tea previously that was sitting in front of us, I didn't really drink it.
no, you didn't. But anyway, we're not changing the name because it kind of works. So yeah, thanks everyone. Thanks, Tony. See you later.
Bye bye.